Are you making good use of your standard deduction? Your standard deduction is an amount that you get to deduct from your adjusted gross income to arrive at taxable income. And you don't have to have spent anything or made any charitable donations or kept any receipts. You just get to use it. And so that's a very good thing. And in 2025, this year, the standard deduction for a couple married filing jointly is $30,000. So that's a nice big amount coming off of your income tax return, reducing your taxable income. But what if you're somebody who does give and have other itemized expenses that would give you a little bit more than that standard deduction? Is that a good thing? Let's think about an example. And let's say that John and Sue are a couple who give regularly to their church and other charities $24,000 a year. They get the state and local income tax deduction because they have property taxes. And here in Texas, they get to take a sales tax deduction from their income tax return. So they get $10,000. That's the max, no matter how much their property taxes might be. They get $10,000 this year. And then they have a little bit of a mortgage left, so they have a couple of thousand of mortgage interest. When we add that all up, the $24,000 of charitable giving plus the $10,000 for the state and local tax, and then the $2,000 for mortgage interest, that's a total of $36,000. That is more than their standard deduction. So instead of $30,000 standard deduction, they have $36,000 of itemized deductions. And they feel very good about that because they're getting some tax benefit for the things that they're doing. Now, they'd still do them if they didn't get the tax benefit, but they do like getting that tax benefit. But is there a way that they could do even better? And the answer is yes. If they double up on that charitable contribution, they take 2 years of charitable contribution and they put it into a donor advised fund. Then they could still give to the church $2,000 a month out of that donor advised fund or whatever other charities they're supporting. But they get the full deduction for the 2 years contribution in the year that they make that gift to the donor advised fund. So if they did that this year, they would have a $48,000 charitable deduction. Now, of course, it has to qualify. They can deduct up to 60% of their adjusted gross income if that's coming from cash, a smaller amount if it's coming from appreciated stock. But that $48,000 of charitable charitable contribution deduction, plus the $10,000 for the state and local tax, plus the $2,000 for the mortgage interest, that adds up to $60,000. So instead of a $30,000 standard deduction or $36,000 every year, they would get $60,000 this year. And then next year, they wouldn't have a charitable contribution to take off of their taxes. They would be using the donor advised fund. They already got that deduction this year. So next year, they could use the standard deduction. They could get $60,000 this year and $30,000 next year using the standard deduction. And then that would go up. But let's just use this year's numbers. That's a total of $90,000 in deductions, as opposed to $36,000 this year and $36,000 next year, which is just $72,000. So they increase the amount that they reduce their taxable income by doubling up in 1 year and then using the standard deduction in the other year. And if they will alternate this from year to year, then they're going to have lower lifetime taxes because they've used their standard deduction more wisely. So I hope that is very helpful to you and will help you reduce your lifetime taxes so that you can be on your best path in your retirement.